Hello, and welcome to the latest edition of Edison TV. My name is Andy Murphy, a director of Edison, and today I am pleased to be joined by Stefani, the finance director of DWF, the leading quoted global provider of integrated legal and business services. Hello and welcome, Chris.
Hi there, good to be here.
Nice to see you, and thanks for joining us. By way of introduction, I was wondering, being the only quoted legal business may mean that the understanding of DWF in the market might be lower than you might like it to be. In a few sentences, how would you describe the business to a potential new investor to help them quickly understand the business?
You're absolutely right. We are the only main market listed, I'll say law firm, but we call ourselves a legal business, and I'll explain why there is a distinction in a second. But there are actually five other listed law firms on AIM, and then there's a whole, globe of large, well-recognized law firms. And the best way to describe it is we're a law firm plus. And that's why we call ourselves a legal business. We are a provider of legal advisory, like you would get from a law firm, but we also have various connected business services that those same legal advisory clients might need. And we also offer managed services via our Mindcrest offering. So basically, we offer that suite of integrated legal services. And we think that's a differentiator in what's quite a crowded market if you just think about the traditional law firm.
Okay, great. Thank you. Just thinking about the medium-term growth targets, which DWF has set at 6 to 7%. Could you give us some color around the key components that lead you to arrive at this level of growth? And DWF has grown, at much higher levels than this. So is 6 to 7% really a challenging enough ambition for you?
That is a fair challenge. I mean, we operate in a market that, depending on which references you look at, the market is growing by around about 5%, albeit we are in very strange economic times at the moment. So I'm not sure the normal market assumptions really can be relied upon the same way as you might have say 2 or 3 years ago. But we believe we've got a differentiated proposition. We can grow via lateral hires, i.e. new partners coming on board, via focusing on our client program, where we've got a large contingent of institutional clients where we know that we could potentially take more of a share of their legal spend. And we also have a global association model where we have sort of best friends relationships and exclusive associations with firms where there's also referral opportunities. So the short answer is yes, growth a little bit above what the market may do, we think is a good base case, and that may be supplemented by M&A. And I think that's why when you look at the historicals, you'll see higher growth rates where we have done meaningful M&A, but on an organic basis, growing a touch above what the market's doing, we think is something that's a realistic way to guide, and hopefully, depending on how the market moves, we'll have a chance to outperform that.
But just on the subject of those growing revenue streams, and I just wanted to sort of dig into the quality of them a little bit. So I was wondering, of the revenue stream, how would you describe the recurring nature of those revenue streams, and therefore effectively the quality of those streams?
So it's very difficult to get true annuity revenue, I think you might call it, in a business that's in essentially professional services. But we have a large insurance business and a lot of large insurers in our client book, and they tend to put work out via panel arrangements where the service level agreements can last anything between 3 and 5 years. Some of those relationships that we have are the length of the firm's history, i.e. 40 years plus. So we have long-standing relationships with those insurance clients, and we view that revenue as recurring, and it's around about 40 to 45% of our revenue base, insurance and insurance-related revenues.
Wow, so a decent proportion. Just thinking about Mindcrest, you mentioned Mindcrest a little earlier on. It's currently the smallest division within the group. So could you describe the huge growth potential it offers and how it can grow with the expanding legal tech budgets in the market?
Well, sure thing. I mean, Mindcrest is interesting and we think a differentiator for a number of reasons. First of all, it is an alternative legal services provider. So that means it's providing legal services with either technology or a different sort of resourcing model. And we purchased Mindcrest, and as far as we know, we may be the only, or we're one of very few law firms that have their own captive ALSP. We know that the ALSP market is growing by between 10 and 15%. So it's growing faster because of those legal tech budgets, as you say. It's growing faster than the general sort of legal advisory market. So that alone is an opportunity. And the fact that it is plumbed in to a group along with a legal advisory business means we can integrate those services and make the client experience easier. So we think it's a great way to set ourselves apart, and it's again one of the reasons why we call ourselves a legal business and not a law firm.
I see. Thank you for that. Just thinking about sort of that additional growth that you touched on earlier on, and the potential that mergers and acquisitions can bring you. The business recently acquired a Canadian law firm called Whitelaw Twining. So could you describe the attractive characteristics of Whitelaw Twining and how these fit neatly with the ambitions of DWF?
Sure thing. Well, I mean, first of all, culturally, it's a group of partners that's very aligned, and they've got a long-standing history in insurance litigation services, which is obviously one of our core offerings. So first of all, they focus on a sector that's absolutely core to our offering. They are a route not into just Canada, but into the North American market, which is a very important market for insurance. They operate in a market where we already had a presence, which was via a claims and adjusting businesses in Vancouver and Toronto. And so those businesses that will be in connected services will now have a law firm to which they can refer work, and that cross-referral opportunity, as well as the sector focus, makes Whitelaw, I think, one of the most strategically appropriate and fitting businesses that we've acquired.
Great, thank you. And of course, connected to acquisitions, let's talk about debt a little bit. Your debt over a period of time has been rising in absolute terms, but the leverage prior to the acquisition of Whitelaw, the leverage ratio has been falling. So is there a target level that DWF is trying to reach, and what would that be and why? And has that at all changed now that interest rates have been moving up materially?
So it's a question often asked because debt in professional services businesses seems to polarize views, and we have, I would say, some stakeholders who would say the level of debt we have is just right. Some say our leverage is too high, and some say we're not aggressive enough in how we use debt. So classic case of you can't please all the people all the time. We have guided the market to say that we aspire to trade between half a turn and 1 times pre-IFRS 16 EBITDA. Now, again, the conventional wisdom talking to investors and stakeholders is that actually half a turn is too conservative, and probably around about 1 times is where we should aim to get to. And that's what our path has been. We're on a steady downward drift towards that, and have made progress there despite continuing to invest and paying down legacy liabilities and so on. I think interest rates, yes, they have gone up. We will see a little bit of extra interest come through the P&L. It is still, though, a cheaper form of funding than, say, if we were to go and raise money in the market. So we think it's still an appropriate way to fund the business. And depending on where we are and what's happening in the world in any given week, the view seems to be that the interest rates have sort of capped out a little bit. So I think we'll watch it closely. And as I say, the medium-term guidance stands. We'll have a steady downward drift that will help to mitigate that upwards pressure on on interest costs.
Great, thanks. While we're on the subject of costs and also staff work-life balance, I was wondering how the business has changed since DWF to reduce office costs, but at the same time improve the work-life environment for your employees.
Yeah, I mean, this is a really hot topic for us, and what I would say is that we moved very effectively to fully remote working because we already had an agile footprint. We did see an increase in productivity where people just didn't have anything else to do. I think now that normal life has returned, normal level of utilization are coming through, but people are also enjoying the flexibility that comes from not being in the office for 5 days a week. We don't have a policy to mandate attendance in the office, but we aspire for people to spend, particularly where they work in legal advisory, client-facing teams, between 2 and 3 days in the office. We started off accommodation footprint anyway, so we had quite a high base point from which to start. So we've got, say, about 28 million of costs in the P&L, and of that is addressable from the point of view of reducing office space, having higher quality space when we do reduce it, and therefore we give people the flexibility we need, the ability to work in a hybrid way, and a better office experience when they do come into the office. And we think that combination is good for our people and is going to be good for the business and good for the P&L.
Great, thank you. Speaking of P&L, and this is the final question, just to talk about shareholders and shareholders' rewards. The company runs a dividend policy which has a 70% post-tax payout policy, and I think most people would view this as quite high. So why are you at DWF happy to stand out from the crowd in this respect?
So I guess a few points of detail around this. So we do say, actually, and this is a very lawyerly answer, isn't it? Up to 70%. So it is a range. And indeed, since IPO, we've never paid out at the full percentage payout ratio for obvious reasons given. So our payout ratio last year was around about 50%. We do want to be progressive in that regard. But I think an important point to note is this: we operate in a market where the traditional model is that of an LLP, which is fully distributing. So compared to a normal law firm, actually a 30% profit retention is actually quite unusual. And I think also the fact that we've not been at that full payout ratio because we're managing our way to kind of progress that dividend, but also conserve capital to deploy on things like M&A and other investments. And it's another important point that on IPO, the partners sold their share in the business, and so we have partner shareholders as well as institutional shareholders. And to the partners, in exchange for their equity in the business, they took a reduced profit share. So the dividend helps to top that up. So it's a sort of intrinsic part of the model because our etymology is that of a partnership, but we still set ourselves apart from a traditional law firm and the ability to invest that they have, or the restriction that they have in investment. So I think the listed model, frankly, is still a competitive advantage to us, even with an attractive yield.
Thank you, Chris. That was a very insightful discussion, and I wish you and the whole team at DWF the best of luck. No doubt we will hear more about DWF and its outlook for the full year 2023 at the trading update to be released in the spring. That's it for now from Edison TV. My thanks to Chris for his time and for you to watching. Until next time.